Hello, and welcome to our latest monthly Horizons discussion from Wood Mackenzie. What we're going to be talking about here is our new report we've just published called Conflicts of Interest, the Cost of Investing in the Energy Transition in a High Interest Rate Era. And I'm delighted to be joined by three of the authors of that report. We've got Peter Martin, who's the head of economics, macroeconomics at Wood Mackenzie. We have Lindsey Entwistle, who's a senior analyst for our Energy Transition Scenarios and Technology Service, and Srinivasan Santhakumar, who is a senior research analyst in offshore wind. And I'm Ed Crooks. I'm Wood Mackenzie's vice chair for the Americas. Now, this is a pre-recorded session, so we're not going to be answering your questions in this chat, but we are going to be available in the comments below. So if you've got any questions that you want to ask us, put them in the chat and we'll try and answer them live or later on as soon as we can get to them. So we're now going to fire away with the conversation. I'm going to start with you, Peter. You were the lead author of this report. I want to talk a little bit about the genesis of it. Interest rates clearly have been a big topic in the economy globally over the past couple of years as the world has emerged from the pandemic. Why did you think it was important to write something about this topic as it relates to the energy and natural resources industries, which are our focus at Wood Mackenzie?
Yeah, hi Ed, thanks. So, as you mentioned there, in the last 2 years, we've seen central banks around the world aggressively hike interest rates in the kind of wake of the pandemic and the shock from the Russia-Ukraine war and the energy price spike. So that's been the most aggressive interest rate hiking cycle for about 40 years in major economies. And that's really brought an end to this zero era for interest rates, a really loose accommodative monetary policy that we've been used to for around about a decade, if not more. And we wanted to look at what pressures that was putting on the energy and natural resources sectors. What does it mean for investing in energy and natural resources? Are all sectors affected equally by this high interest rate environment? And also we wanted to consider, well, what if interest rates aren't going back to zero bound? We're likely now to have a period of a couple of decades where interest rates are significantly higher than we've had in the last 2 decades. So we wanted to look at that impact of not just the short-term pain that is maybe being experienced at the minute, but also what the longer-term impact is going to be.
And as you say, then, so we were in that, it's often referred to as the zero era. Interest rates were not necessarily exactly at zero everywhere in the world, but it was certainly a period of very low interest rates coming out of the great financial crisis, 2007, 8, 9, and for, I guess, more than a decade after that. What do you think now? As you say, it seems like interest rates are going to be higher for longer in the future. Is that kind of now, does that now seem to be kind of a one-off event, that there were those particularly kind of special circumstances of slow economic growth after the financial crisis that meant that we had these really kind of unusual conditions in the world economy that meant interest rates were unusually low? And it's really what we're seeing now, a kind of a renormalization to what we'd expect long term.
Yeah, I agree with that. I think, the zero rate era, as you mentioned, it was the kind of a coordination of central banks cutting rates close to or around about zero. And it was really the remedy from the financial crisis, 2008-9. And we also had, it was to try and provide liquidity, asset price support into financial markets. But then we also had some structural factors, which meant that economic growth was low, inflation was low, so we had weak productivity in a lot of developed economies. And that just led to this prolonged period with rates being very low. We also had large amounts of what's called quantitative easing, so asset purchases by central banks, which also held down bond yields. So they were purchasing government bonds and government bond yields were lower. So interest rates from central banks were low, interest rates on government debt were low. And really, I think it extended a lot longer than anybody was really expecting at the time when they needed to make those cuts back in sort of 2008. But now, just before the pandemic, we did start to see some of the normalization of those rates. So US rates were going up, UK rates were going up to not quite the same extent, but we were getting back towards this normalization. Then we had the pandemic shock, which kind of prolonged the zero era. And then we had the post-pandemic inflation spike, which very quickly brought the zero era to an end. But coming out of that, even though inflation is now beginning to ease in a lot of major economies, the question is, where will interest rates end up in that kind of normalization period? And we see that there are some inflationary drivers in the global economy which we think are emerging, which will mean that central banks will be able to get inflation back to their longer or medium-term targets of around 2%. But it's going to take a tighter monetary stance in order to keep inflation around those levels. And those inflationary factors are around things like the kind of deglobalization we're seeing, so trade being a smaller share of global GDP. We're seeing increasing trade conflict and tension. We're seeing policies which are prioritizing making things in your own economy, making things with or importing from your neighbors and your allies at the expense of the economics. So it's sort of protect your supply chain, protect your domestic industry at whatever cost. And that is leading to a more inflationary environment, we think, in the next couple of decades.
Yeah, that's very interesting. And I think you could say that even just in the past few weeks, there seems to have been a lot more of a realization of that after inflation fell very sharply over the past couple of years, seemed to be expectations building that interest rate cuts would be on the agenda. But recent data, the way that's been coming in, I think people have rather moved to the position that there's still quite a lot of embedded inflation in the system, certainly in the US, in some other developed economies as well. That means that those expectations of imminent rate cuts were very much on the optimistic side, and probably we're not going to see any movement in that direction soon, probably not at all this year. Is that fair?
Yeah, I think that's an interesting thing between when we started writing the report and by the time we'd kind of finished and published the report. So at the time of writing and doing the analysis at the start, very much the market consensus was we were on the verge of the first rate cuts from major central banks like the Fed, like the ECB, like the Bank of England. And that's kind of changed now in the last 2 months. So inflation looks a bit stickier, between 3 and 4% in some of those economies. The Fed is obviously dialing down some of its guidance on the expected rate cuts that are coming up, or expected to come up later this year. We're starting seeing more market bets that actually the Fed could increase interest rates if inflation continues to tick up rather than continue to slow. One difference, I suppose, is that maybe the ECB now looks like it might be the first bank to cut because inflation is closer to 2% in the Eurozone. So the question in the short term is the picture has definitely changed somewhat since we started the report, but that just adds to the point that we're making, that the risk of higher for longer is there. And really what we're interested in is the longer term period. So even if rates do come down a bit this year, next year, as central banks get interest rates or get inflation back to target, it's really the point that they're not coming all the way back to the zero bound. They're going to be normalizing at a higher rate. And that's not something the global economy has had to deal with for quite a long time now, since the great financial crisis.
Yeah, got it. So, Srini, I want to come to you in a moment just to talk about some of the granular implications for renewable energy in particular. But just before I do, Peter, last thought from you on this, which is then if you step back and look in the broadest terms at what this new world of higher interest rates means for the energy and natural resources industry, how would you characterize it?
Well, I think from the analysis we did, and not wanting to step too much on Srini's toes, is like the way we looked at it was, projects and technologies and energy sources that are more capital intensive and have, so by that I mean, a greater share of capital relative to their OPEX, and ones that have a long, say, lead time in terms of the investment phase to getting to operational phase and seeing revenue, and those that are using more debt rather than equity financing or exposed to project financing, those are the ones that are most at risk from a higher rate environment. And those tended to be the lower carbon technologies, so in the renewables, in wind and solar. They also tended to be nascent technologies like things like carbon capture and storage, hydrogen projects, things that are at a very early stage of development, which need to play a key role in the energy transition going forward, but are going to feel more of they're more exposed to the higher interest rate environment.
Right, got it. Yeah, so let's drill down into that a little bit with you, Srini, if we can. So you did a lot of the modeling for the report on the impact of interest rate changes on costs in the electricity sector. What does that modeling show?
Definitely, thanks, Ed. So the first thing is the fundamental difference in the cost structure between renewables and also the conventionals. Renewables, like Peter was mentioning, is mostly driven by capex expenditure, but if you look at the conventional, it's mostly about OPEX, whether how much is the fuel is going to cost or how much the carbon prices, if it is high enough in a particular market. So this fundamental difference makes the increasing interest rate disproportionately affects the renewables more than the conventional. It's not that the conventional power generation is not affected, but because of this cost structure difference, renewables is affected more. And that's what we are seeing in the LCOE of power generation of renewables in the recent years. And also with the interest rate staying longer, so we are also expecting higher LCOE than what it used to be in the previous years.
So can you quantify the impact a bit? I mean, how much difference does a particular change in interest rates make to the LCOE of different types of power generation?
Yeah, mostly even in our report, we were mentioning about like close to 15 to 20% for 2% rate increases, and interest rate have increased more than like 3 to 4 points since 2021. So obviously the impact has been more than that. And we have seen like a lot of contract prices increasing about like 50% in total. So I would say like big chunk of it also comes from the interest rate increases there.
Right. So these are huge impacts then. So just to walk through that a little bit. So if you're saying then, as you say, 2 percentage points increase in interest rates equals a 15 to 20% increase in the LCOE from renewable generation, and rates have moved 3 to 4%. So just doing the mental arithmetic here, so that's potentially a 40% increase in LCOE for some forms of renewable generation as a result of the interest rate movements that we've seen in the past couple of years. It's huge, isn't it?
Yeah, it's definitely huge. Yeah, and that's also we are seeing a lot of postponements of investments in the recent years.
Yeah. And at the same time, we've had, of course, a lot of other challenges with renewable energy in terms of supply chain issues, supply chain tightness, cost inflation, high cost of raw materials, and so on going on, some of which has started to subside, but some of it hasn't. I guess that's all contributed to a picture of renewables starting to struggle in some markets.
Definitely. Steel prices have been a bigger factor, like all the commodity prices, but most of the commodity prices have come down, but the impact of interest rate is still there.
Yeah, no, indeed. And of course, worth bearing in mind that while this has been happening, still we've had very extensive global support for renewables, and in lots of sectors, actually, investment has continued to grow very rapidly. And last year was a fantastic year for solar investment worldwide. It was a good year for wind. One of the sectors, though, that does seem to have been very specifically affected is offshore wind. And we've seen a lot of difficulty in offshore wind, particularly in the US, but also to an extent in Europe as well. And we've seen projects not going ahead, offers being withdrawn, and so on. How much of an issue do you think in offshore wind specifically has this higher interest rate picture been?
So far, it has been a big factor, but it's not the only factor, I would say. Like offshore wind itself is like a completely different compared to onshore. It has long lead times, and also the supply chain itself is emerging, so which is making it more vulnerable to macroeconomic challenges and also material events in the supply chain. So when we look at the impact has to be looked at in two stages. The first stage is the component price have increased because of the supply chain, and then the commodity prices, and then which kind of resulted in increased capex expenditure, and you have to finance that at a higher interest rate. So that kind of inflated that higher capex into the production cost. So, and as we say, the auctions, most of the offshore wind auctions are very competitive, and the developers rely on the thin margins. So there is no room for them to offset this increased cost. That's why we are seeing a lot of cancellations, delays in financial investment decisions.
Yeah, no, indeed. So we've had an interesting question actually from the audience. We had questions that people were submitting in advance through social media channels and so on. And this one I think was particularly good. And I think Srini might be one for you to answer. Someone asking a question about to what extent these higher interest rates are really being factored into business decisions. And this person is saying, what is the impact on developers and IPPs in terms of asset valuations, return expectations, and hurdle rates? Based on what I've seen in the market, most of the players are still using the previous hurdle rates in order to stay in the game. Can higher interest rate expenses pass through to off-takers under the PPA mode? And also a question about will current high interest rates persist? I guess we've answered that point about what we expect in terms of the interest rate outlook. But what's your sense of it, Srini, in terms of the hurdle rates that people are using now?
So for small scale investments, I would say like the onshore renewables like solar PV or wind, they can be still developed under the balance sheets of developers. So it makes sense that they are still using the previous hurdle rates. But for example, if you take offshore wind, it has grown at a large scale, and it's not anymore at the scale where you can develop from the balance sheet. They have to raise fund outside, and obviously they have to pass on that increased financing cost to somehow. So yeah, I would say that is the differentiation between how scale the investment is, between using the previous hurdle rates to stay in the game and to make on a huge investments and to look at how to pass on that cost to the subsidy or consumers.
Right. Yeah. One of the sayings I always like on this subject is one of the crucial raw materials for renewable energy is money, and the cost of that money has just gone up, and so inevitably that, as you say, affects evaluations and everything to do with projects. The other point then in that question was also interesting, Srinivasan, maybe just finally for you end on this thought, which is what about passing on those increased costs of financing in higher PPA prices? Is that what we're seeing? Is that something that developers have been able to do?
Yeah, in the last years, developers are able to do that because with the energy prices, the power prices were also increased in the most of the developed markets, and they were able to sign PPAs at a higher price, so that partially offset the increased cost. But for the offshore wind, the contracts have been signed like 2-3 years before, and there was no room to offset this cost. So that's why we are seeing in that offshore sector a lot of cancellations and renegotiations. But obviously the power prices have also come down this year, and also just it's not at the same level as the year before. So we are going there should be some mechanism to pass on the increased costs. So.
Yeah, got it. So Lindsey, I want to turn to you now and think about what this means for the energy transition globally. So we've been hearing about these very significant increases in the costs of renewable generation. We've been hearing about projects being cancelled, abandoned in some sectors, particularly in offshore wind. When you take a step back from that and kind of aggregate it across the whole of the energy system worldwide, does it mean that the transition to low carbon technologies is slowing down?
Yeah. So, and that's a key theme in the report. Higher interest rates are a real headwind to the low carbon energy transition, and we are definitely seeing the pace of that transition start to slow down globally. The outlook for renewables and energy storage, electrification, low carbon fuels, we'll still see these continue to grow. But the pace is definitely starting to be constrained, and we might see a potential upside for oil and gas in the near future. The reason for this, and we've spoken about this, is the higher cost of borrowing, increased supply chain costs are all impacting investments in low carbon infrastructure and new technologies, more so than you would see in fossil fuel projects. And governments and businesses are having to deal with this. Funding just isn't going as far. You look at the UK, for an example of a mature economy, the priority has been the net zero transition for the past couple of decades, and we're still targeting net zero by 2050. But the priorities are starting to shift and are having to deal with the real financial issues that we're seeing. And we're seeing knock-on impacts to various sectors. The ban on new petrol and diesel vehicles has been pushed out. The gas boiler ban has been pushed out. And then on the flip side, in terms of prioritizing where those funds are going to be allocated, you're talking about offshore wind. There's been high-profile project cancellation in the UK last year due to high costs and high inflation. And no bids from offshore wind in last year's contract for difference round, because the prices it wasn't going to be commercially viable. But the UK government is actually prioritising offshore wind in the transition and trying to address that, and has actually increased the strike price by around 2/3 for 2024 to really try and bring developers back to the table. If you look at hydrogen, we expect investments and subsidies to continue, but there'll be fiercer competition between projects to actually access the funds, which might delay growth in the sector. But then when you look at carbon capture as an example, there might be short-term delays because they're really capex heavy projects. But in the longer term, there's likely to actually be an upside if the transition is delayed, because the more carbon you put into the atmosphere, the more you're going to have to capture, and the more essential carbon capture becomes. So really a mixed bag there.
Yeah, no, indeed. That's a fascinating point, which I want to come back to in a moment. Before I do, though, I'm just on that point about strike prices rising, and really to the point Srini was talking about how renewables producers are able to secure PPAs at higher prices. And so price of offshore wind in the UK, then you were saying, has risen very significantly. Is this not a bit of a Pyrrhic victory maybe for the developers, people who are investing in these projects, because you get a higher price and that's great, and so the economics work and the project can go ahead. But if it's less competitive against other forms of generation, that cost has to be paid somehow, and it's whether it's through the contract difference mechanism or carbon pricing or some other system, whatever it might be, the burden of that increases, and that's a cost that has to be paid by bill payers or by taxpayers or by somebody. So it's kind of not, it's certainly not a kind of unambiguous good news story for the industry, is that that's still a problem if costs are higher.
Yes, and I definitely agree with that point. Ultimately, if you're increasing the price of these renewables developments, that's going to have to be covered somewhere, and it's eventually going to be passed on to consumers, or have to be subsidized further into the future. But when you look at the price of gas in the long term in the UK, and the issues that have been had in Europe over the last few years, transitioning away from gas, and the impact that's actually had, increasing inflation and interest rates. I think it's a net benefit for the long term.
Yeah, that's a good point. So we've just been looking at this. I mean, you specifically in your energy transition team have been looking at this, haven't you, in terms of a new delayed energy transition scenario. People may be familiar with scenarios and forecasts that we produce at Wood Mac. We have what we call our base case forecast for the energy transition outlook, which is essentially our view of what we think is most likely to happen. And we've also been showing two scenarios for possible states of the world with a faster transition towards low carbon technology as one, essentially a net zero scenario aligned with getting to net zero emissions globally by 2050 to meet the goal of the Paris Agreement of limiting global warming to 1.5 degrees Celsius. And another scenario showing accelerated transition towards zero emissions based on the pledges and policies that countries have made and put in place. Now we have this, as I say, delayed energy transition scenario, which is a kind of a different view of the world, which is saying, what if progress towards decarbonisation is even slower than on our central expectation? Do you want to talk a little bit about that, Lindsey, about why we've thought that scenario is necessary and broadly speaking, what it shows?
Yeah. So you've covered what we already do, which is annually publishing these different scenarios, trying to take an integrated view of the whole energy landscape and what is happening geopolitically. So the base case, pledges case, and net zero case are updated each year, and we do try and build in the changes that are happening across the world. Since our last update, we're seeing a number of challenges build when it comes to energy transition, whether that's in politics and sort of the pace of policies supporting the transition actually being implemented, or whether it's these high interest rates that we're seeing. So yeah, my colleagues have recently published this really great piece looking into what happens if there is, or what's the impact if there is a 5-year delay to the transition. What does that look like across the whole energy sector? What we're seeing is, if you take the base case, we were looking at oil and gas peaking in the early and sort of later 2030s. In the delayed case, you're still looking at oil peaking in the 2030s, but gas is staying strong out in sort of mid 2040s before it starts to come down, because it's having to fill those gaps left where maybe renewables aren't being deployed at pace. And in hydrogen, for example, and carbon capture in the base case, our base case outlook has 200 megatons of hydrogen production by 2050 and 2 billion tons of carbon capture. So like I was saying, there might be a long-term upside, but actually in the delayed case, by 2050, you're looking at half those volumes actually coming into play. So yeah, we'll continue to build these into our future base case outlooks, but we just thought it was really important to react to what was happening in the world at the moment.
Yeah, that's really interesting, and that's definitely a point worth discussing, I think. So as you say, one sort of implication of all this, higher interest rates putting these obstacles in the path of renewable energy, other forms of low carbon energy, creating these kind of headwinds, various other shifts around the world, potentially meaning that deployment of low carbon energies is not going to be as quick as looked possible a couple of years ago. We were already not on course to meet the goals of the Paris Agreement. It looks as though we are, as a world, drifting even further away from a pathway that would get us to meeting those goals. So, question, what can and should be done about that, and what are the right policy responses? And as you say, Lindsey, so one possible response is to think that we're just going to need to do a lot more in terms of carbon capture and sequestration and use, whether point source, maybe leaning more heavily on direct air capture and so on. But what are some of the other options going to be? I mean, Peter, maybe come back to you on this. I mean, when you think about what could be done in policy terms, given this picture of mounting headwinds to the energy transition that are emerging, what offsetting actions could policymakers take, given that they are still notionally committed to achieving those Paris goals?
Yeah, I think in terms of the response, there's two sort of areas to look at. I think there's one, how do we offset the higher interest rate environment itself? So how do companies, operators, investors try and avoid those higher rates? So one of those could be to look at their capital structure, that how do they bring other costs down? How do they lower the risk of projects? So, in one way, the interest rate is reflecting the risk of projects. One of the things in the report we look at is how the oil and gas and the metals and mining sectors went through a big deleveraging in the middle of the last decade, and they're relying more on equity financing. So do we need to see a shift in the kind of debt v equity financing, which would help again lower the burden of interest rates. So those things directly trying to challenge, or how do you access a lower interest rate. Then there's things policymakers can do on that front. So they could offer discounted rates for low carbon technologies and investments. So these are notions of green rates. Can we offset a bit through that? And then I think there's a whole other tranche of things, and I say, right, well, the reality is that there's not a huge amount you can do to the wider macroeconomic situation, and that higher interest rates are here. We can do a bit to try and offset them, but really let's focus on some of the other major things which block or slow or delay energy transition. So things like the pace of permitting, the things like providing clarity and for investment. So in areas related to carbon, how do we have more certainty over carbon prices, over carbon mechanisms, carbon offsets? If things like hydrogen, how do we provide hydrogen markets, subsidize hydrogen, those sort of things. So two different kind of tranches there. I think ones that directly address the industry and environment we're in, and then the other one about how do we get rid of some of these other barriers, which are clearly having a dragging effect. We are seeing some progress on those. Even this year, there's been progress.
Yeah, that's a really good point. Srini or Lindsey, do you want to come on this one in terms of sort of advice for people in thinking about responding to this more challenging environment, whether it is policymakers or maybe for companies, for investors in these sectors? Are there things that people can do to help manage and offset these difficulties?
Definitely. I think Peter covered most of the points, but if you look at the last decade, in terms of policy, a lot of the actions have been targeted towards decreasing the cost of renewables, like introduction of the CFD mechanisms. And CFD mechanisms have helped a lot. Like in the 2022, when the electricity prices were higher, some of the generators were paying back to the system because it is a two-way CFD. So when the prices were higher, they were actually paying back to the system to benefit of the system. So the policymakers have to go back to that place again to de-risk the projects and to kind of accelerate the investments. So in the end, the higher interest rate is a cost. So they have to think along like how to de-risk the projects further. So, they also have to come to an agreement that this is going to stay longer a bit, but also we have to look at the other options, like how to de-risk the projects and also ask developers to go ahead with the investments.
That's very interesting. Do you get a sense that policymakers, politicians, leaders of all kinds, regulators have an understanding that that's what's needed? Are those kind of ideas getting any traction?
They did that last year, but in the near term, most of the policy action have been increasing subsidy prices because they don't want to lose the momentum. But to look at in the long term, when thinking about the interest rate could stay longer, they also have to think along like other mechanisms, not just making more higher subsidies, because we also talked about the subsidy efficiency in the report.
Yeah, that's a great point. So I think we just about have to leave it there. Maybe, Lindsey, I don't know if you have a final thought. Is there anything else you wanted to say that you think people should be thinking about on this subject?
I think I'd probably just reiterate, higher interest rates are definitely constraining the transition at the moment. We're seeing that, but there is still a global consensus that the transition is needed for energy security and to shore up domestic industries into the future. And we will continue to see governments, corporations, and the energy majors investing into low carbon energies. And it is just about getting that approach right in terms of policy stability and all the other different approaches that governments need to do to adapt to make that happen.
Well, fantastic. Lindsey, Srini, Peter, thank you all very much for a great discussion. As I was saying, if you've got questions, please do post them in the chat and we will get to answering them as many as possible as this is going out, being broadcast. But as I say, that's all of it from us. We're going to wrap up now. Thank you very much indeed for joining us. So thanks again to the panel. Fantastic discussion we've been having. And before we go, just wanted to remind you that you can read this most recent report on interest rates and all of our Horizons thought leadership reports. And you can also sign up for our weekly insights at woodmac.com/horizons. This has been a Wood Mackenzie production. Thank you all very much for coming, and we'll see you next time.